and welcome to today's presentation. What I'm going to be talking about today is how to spot order flow trading opportunities. These are great times to be in the markets. Since last Friday, markets had a lot of volatility, a lot of movement up, a lot of movement down, more importantly, over the last several days. And today is no different. So what I'm going to be talking about is opportunities that other traders don't see. When traders go on Twitter and social media, you always see this quote: to be successful, you have to have an edge. Well, they don't really tell you how to find your edge, right? They just say, it's just a blanket statement, which everybody says. I mean, there is truth to it. You have to find something that works for you, that is going to give you an advantage over other people. It's just like whether you're playing a sport, right? You have to be good at certain thing. If they say you play football, right? American football. If you're good at a certain position, that's your edge, right? If you play poker, being able to tell what other players are doing, that's going to give you an edge. And it's no different in the market. There's different ways to find edges. So what I'm going to share with you today is about how I developed my edge in the markets with order flow. And it's from order flow that you can spot more trading opportunities, right? I'm here to help you. That's why I love doing these presentations with Investors Expo, is because it gives me a chance to share with everybody, my experience, right? And if you're new to one of my presentations, let me just give you a brief background on who I am, right? I'm not somebody that just, took up trading a few years ago and think, I'm in the middle of a bull market, that, I'm the next Warren Buffett. No, I've got over 25 years professional trading experience. I started on the CME floor, literally at the bottom, as a runner, right? Which is, the lowest job you can get on the CME floor. That was back in the 1990s. And as electronic trading started growing and becoming, in my opinion, was going to be the next big thing, nobody didn't expect all the floors to close up as quickly as they did. I eventually left the floor and started trading on the upstairs trading desk back in the 90s, when Globex on the CME started really gaining a strong foothold. And, the Chicago Board of Trade had what they call Project A. NYMEX Colmex had their electronic trading system called Access. And, I started doing that for several years, and I realized, this is where the future is going to be. I got to really, immerse myself in it. After 3 years at Dean Witter, I joined the English trading company, EDF Man, in Chicago on their global macro futures trading desk. I spent about 2 years there before joining the big German bank, Commerzbank. We had a desk in Chicago, and we had one of a handful, I think there was like 6 or 8 actual Eurex trading terminals in the United States. And then the CFTC put a moratorium on them because they didn't want the competition. So, back in the late 90s, I was one of literally just a handful of people trading on the Eurex exchange in the U.S. Then, after September 11th, I took some time off. Then I joined Cargill, the big commodity trading firm, which just regained top position as the largest privately held company in the United States. And just put that in perspective, if it was a public company, it would probably be ranked 7th or 8th as the biggest public company in the U.S. But, they account for most of the grain exports in the U.S. When I say most, I mean, about 30%, meat exports, about 25%. And they sent me out to Singapore when the exchange was closing down there, or not closing down, but the floor rather was closing down and was going electronic. And they wanted someone with electronic trading experience that can set up a trading desk there. That's how I ended up out in Singapore. And after setting that up, I joined JP Morgan. I spent 8 years there at JP Morgan as vice president of futures trading. And these are actual trading jobs, banging away on the trading system, every day buying and selling. It's not like I was just, sitting in an office somewhere looking at spreadsheets. No, I was there trading, seeing what the effect of an order would have on the market, doing all the stuff that traders do. I left JP Morgan in 2013, and a few years later, while I was trading for myself, I started a company called Orderflows.com. Now, the reason I'm telling you that is because, the charts that you're going to see are generated from the Orderflows Trader software, and it runs on NinjaTrader. So in 2015, I released the original Orderflows Trader software, which is software designed to help traders understand what's happening in the order flow. Okay, so we have pre-programmed tools in it that will help you not just see the order flow, but really understand what is going on in the order flow. I mean, it's one thing to be able to see the order flow, but if you can't make heads or tails of it, it's not going to be of any use to you. So again, the charts and tools that are used in this training are generated from my Orderflows software. But what I'm showing you today, you can be using it with, there's a lot of other software out there that already has footprint charts. So if you're using another software, hopefully you can take what you've learned today and apply it to the software you're already using, because now you know what to look for. And I'm going to show you how you can quickly and easily apply order flow analysis to your trading so you can make better informed trades. Now, if you stick around to the end, I realize that a lot of people, sometimes this is all new information to them and it just feels like you're drinking from a fire hose. So I'm going to show you how to get a copy of my book, Trading Order Flow. It's a 150-page book. You're not going to get a hard copy. You're going to get the digital download, but you're going to get it for free, all right? Because, that's my way of giving back to the trading community. Now, just a brief disclaimer, we all know trading involves risk. You should only trade with risk capital that can be lost without jeopardizing one's financial security or lifestyle. Don't go trading with money you can't afford to lose, in other words. So why order flow? All right, so what attracted me to order flow years ago, when I say years ago, I'm talking about in the 90s, was being able to see things happening in the market that other traders just don't see. Just seeing an order come into the market, all right? When there was a trading floor, open outcry of the pit, you can see the orders coming into the market. Then when we started going electronic, and I had the actual CME Globex trading terminal in front of me, I could see the orders hitting the order book and getting executed. Right? If you were just looking at a CQG back then, there wasn't many quote systems out there. It's like CQG, Thomson Reuters, DTN. And you just see the print go through. But being on a native terminal, I was able to see what was coming in, what was trading. Nowadays, you get all that information on pretty much any front-end trading system. And not a lot of people are using it. A lot of people are still stuck on following the price on a chart. But what I'm going to show you is how to dig deeper into that chart and analyze the information that's available to you. Right? Because it's with the order flow that you're going to be able to understand why a market moved when seemingly there was no reason for that movement, right? Or why the market stopped at a particular level. Okay, so for example, this was, 2 days ago, this was in the E-minis, right? We had a big sell-off overnight. And the market started selling off, then it rallied back up, right up to this level, 46.40, and then it tanked. Well, as a trader, right, you always want to know, oh, I wish I could have sold it over here. Well, if you knew what happened in the order flow, you can see just by looking to the left if there was anything here, right? And I'm going to show you how using software is going to help you do that. Because, if you could get in up here, right, with a very, what I call a low risk trade, put in an offer up here at 46.40, while it's trading down here at 4,600, you have an offer sitting up there, with a 2 or 3 point stop to catch that 40, 50 point move down. And if you're looking at the order flow, you will know that, up here at 46.45, over here at 46.35, there was very aggressive selling. And as a trader, what you're going to want to see is when the market comes back to those areas where you had the aggressive selling earlier, right? First time you came back up to this 46.35-ish area, the market came off a bit, sort of struggled around there, then went back up through it to its next level up here, tested it, came off. Doesn't look like much, but this is actually a move of, about almost 20 points right here, this little move, because, it was just a gigantic move this day. But then, it came right back up again, tested that level again, and sold off. So what's that telling you is, the first time there was still sellers up here, right? came back up, you're still expecting sellers up here, right? And the market sold off. Again, you're not risking, 20 points or anything. You just throwing an offer up in here, with, a point or two risk. You don't need to risk such big amounts, right? But it's giving you a nice entry to catch a nice move down. So order flow is based on what's happening right now in the market, right? It's based on the trading that's happening, and it's based, more importantly, on the present, right? Not the past. So, even though I say it's not based on the past, there's a level here from the past, but as we're coming up, is the market confirming that it's rejecting these levels, right? When I say you're trading in the present, as the market comes up to a level, whether it's based on order flow or your own type of level that you determine, watching how the market reacts in the order flow, it's going to give you an edge over other traders, because you can see whether that level is being rejected or being accepted, or if we're going to go right through it. So what benefits traders more is analyzing what's happening right now in the market based on what's trading right now. And that's where a lot of traders sort of miss a step. Okay, they think that, I have my level, that's all that I need. Well, really, you got to start watching what happens when the market reaches your level, right? Is the market going to react to it or not, right? I mean, one of the problems with people with technical analysis, they think it always has to work 100% of the time. It doesn't. And if you've ever studied technical analysis, maybe, there's all these different formations and patterns. Some of the best ones maybe work about 60%, 65% of the time. That's not a very good winning percentage per se, but more importantly, you can increase that level by seeing what is happening in the market, in the order flow, as you reach a specific level in the order flow. Okay, so in order flow, right, there's three main building blocks. There's delta, point of control, and imbalances. Okay, and most order flow software will show you all that. But I wanted an easier way to analyze that market generated information rather than just put it right in front of my face. That's why I created my own software, the Orderflows Trader 3.0, which takes the information that you see in the time of sales and depth of market and transforms it into an easy to read format. Okay, because it's not like when everyone thinks of mobile phones, they think of the iPhone. Steve Jobs didn't invent the mobile phone. He just took the existing technology and made it better, right, by improving it. And that's sort of what I wanted to do with order flow, right? I wanted to take the existing technology and improve it to help me with my analysis. Now, have you ever stopped and thought about how your chart is constructed? Most people don't. They think, it's based on, high and low. And, and it is. It's basic, right? This is your basic candlestick chart, red bars, green bars. Okay, and you got your wicks. You got your open, your high, your low, your close, right? But where does all this information come from? Well, it comes from the time and sales, right? It's the record of every trade that occurs on the exchange. And there's a time stamp, there's a volume stamp. It tells you how it traded, whether it's on the bid or the offer. Honestly, I didn't really, it took me a while to really appreciate the value of that information. What was trading on the bid or what was trading on the offer. I remember the old CBOT Project A system would show the aggressor of a trade, meaning, if the bond market was, 16, 17 and someone bought 100 at 17, that was valuable information. I didn't really, at the time, I'm like, I don't really need to see that. But once I started processing it and understanding it, because, in the past when there would be a big offer or a big bid, I'd always just sell one into it so I could see who's that on the other side. But then when I realized, hey, now I can see who the aggressor is, right? Who's selling the 100 into the bid or who's buying 500, from the offer. That was good information. And it's the same thing, even though now you don't see the counterparty, but you can see, which side is more aggressive. So a footprint chart, the basic footprint chart has, your delta, which is the difference between aggressive buying and aggressive selling. It's got your point of control, which is your level with the most volume. It's got imbalances, right? So it's telling you the price level or in the two-way auction that has, more aggressive buying than aggressive selling. But that's just the basic software. And it had been that way for about 10 years. But I would always, do my own analysis, right? And I know a computer can help me by doing that analysis for me, right? I could read the importance of certain imbalances, where they appear in a bar, where does point of control appear in a bar, how is delta shaping up in a bar, and things like that, right? So as you can see, there's just so much more information. You still have, your candlestick, right? You still know where the market opened, where it closed, what the high, the low is in the bar, but now able to take it a step further, right? I can see where traders are being more aggressive at a certain time or a certain price. If there's a big support level in the market, or if what is trading is forming a support level, right? So again, there's more to it than just seeing delta, imbalances, and point of control. You got to start putting those pieces together. It's a bit like a puzzle. So when traders first learn about order flow, they just learn what delta is, what point of control is, what imbalances are, and that's good. You need to know that. But then they're sort of left to figure out, what does that mean? How to put these pieces of information together. And it's difficult for people, honestly. It's like I've got kids who are taking lessons. Like right now they're in swimming lessons, and they're trying to learn the importance of well, this is this stroke. Well, why do you need to use that, and when do you need to use it? And it's just the same as delta or point of control and imbalances. You don't use it all at once. You use imbalances at this particular point, or you want to look at point of control here, or you want to know what delta is doing here. All right, so you got to know how to use it. So what I'm going to show you is, again, it can be done by just looking at any footprint chart. I'm going to show you on my footprint chart, and I'm going to show you some of the tools that I've developed to make it a little bit easier. Because when the market is moving, just like today, I said yesterday, but today it's up and down, right? Yesterday also up and down, and it's easy to miss things, right? Because the market's moving so fast. Sometimes you get excited if you're watching, the dome, prices just jumping up and down. You're going to easily overlook things and miss things. So, I'm a big believer in let the trading software do the heavy lifting for you and show you things in the order flow, right? Like whether it's market weakness or market strength, right? Or price rejection. Because after all, order flow is about understanding what traders are doing in the market, right? And you need an easy way to process that information. Don't make trading too difficult that you can't understand what's happening, right? But again, you got to know how to connect the dots, right? You got to know when to use delta, when to use point of control, when to use imbalances, right? And how to put them together. All right, so common understanding of market theory is that markets move from balance to imbalance to balance. That's basic, right? But what traders fail to often consider is what happens when the market moves back to its previous imbalance, right? Because, literally for the last year, market's just been, straight up almost. Well, not straight up, but on a 45-degree line. But, markets retrace all the time, right? They come back to previous areas of imbalance. They just go from balance to balance. Sometimes they go back to an imbalance area. And again, this is just yesterday. A lot of these, this is just last night, 12 hours ago. We hit our high, market came off, and rallied right back up to this level here, 45.34, and then stalled off a bit, good 5-6 points. It's 8 o'clock last night. Well, that's because there was aggressive selling interest there, right? We had just hit the high. What we have here is what we call a stack selling imbalance, right? This is order flow 101, stack selling imbalance. Very nice, neat, easy to see, right? You have imbalances in the order flow, 30 against 0, right? In the two-way auction at this price, 34 against 34 and a quarter, 30 lots traded on the bid, nothing on the offer. 33 3/4, 7 lots versus 1 at 34. 33 and a half, 6 versus 0 at 3 3/4. So what you have is a stacked selling imbalances. You have 3 selling imbalances all neatly stacked on top of each other, right? And then you have this zone drawn out. Now our software will draw the zone out until the price comes back up to that area. So you can see Market sold off, circled right back up here, hit this area. We got through. It doesn't necessarily mean it has to stop right on that area. When the market's a little bit more volatile, like today, sometimes you breach the area by a few ticks, and then you continue in that direction. But imagine you're sitting in here with an offer, at 33.5. A stop, maybe a point, 2 points, 1.5 higher. 35.5. You could have easily just gotten a quick 5 points. Right, over the next 5 minutes, it just came up that area, came off, and you're only risking, 1.5, 2 points, 2 points to get, 5 points? That's a 2-to-1 risk to reward ratio. Right? This is yesterday during the day session, right? Market's coming off, right? Bounces back up, just sort of stops here at this 41-ish area, goes sideways, boom, 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 and then sells off 10 points. Well, why? What was happening here? This is not an area where it's like, you had some resistance coming in here or here or here. People will say, well, you got to draw this line out from here. No, you don't. Just look at the order flow. Because earlier, as the market was selling off, you had this stack selling imbalance here, right in here at 41. Right? You just have an offer sitting in here at 41. Right? It's, with a stop at, 42, 42.5, 43. That's going to give you a nice, look at that. It sold off from 41 all the way down to 30. Again, you're just risking, 1.5, 2 points to get 5, 10 points out of the market. Okay. It looks very similar to the previous chart I just showed you, right? But this is later in the day. This is around 12:30 yesterday. The first chart I showed you was 10:30, right? Market's coming off. Comes right back up, sort of stops around this area up in here, around 06, 07, and then it sells off right down in here, right? Another 10 points. Well, why? You have this stack selling imbalance right here, right? It don't make trading so complicated, right? This is a very basic, very easy to see, very visual thing to see on your chart. Again, you throw an offer in here at 06, 07, to stop at 8.5, 9. Even in the next in that area, there's one bar you could have sold those 7s and covered it down almost at 00. You could have got your 5 points right in this one bar alone. Now, market sold off, right? We sold all the way down to at this time was around 80. Right. Well, why did the market stop here and all of a sudden rally? Right. It rallied from the 80 area all the way up to 95. Well, earlier, from the day before, actually, you had aggressive buying interest at this area. It took almost the whole session to come back to that level. But imagine, if you just this level, right? This is the level you saw yesterday. Finally got back down to that area. Breached it by a couple ticks, but again, if you're buying it in here at 78, you got to stop at 77.5 or even 76, 77. Boom! It just rallied right up. It's a nice strong move up. Right, came all the way back down. Right, we're trading 46. What was the high yesterday? Like 46.50. Came all the way down. Finally hit that area. Then we rallied almost immediately. A quick 15, 20 points. Now, stacked imbalances are nice, right? They're very visual, they're very easy to see. But every order flow trader can easily spot it, right? And there's nothing wrong with that because it's good because you want other people to see what you're seeing and do the same thing because that's going to help you get those moves, right? It's going to be difficult if you're always trying to swim against everybody, so to speak, right? If you think you have a magic way of finding your own levels, but nobody else is seeing those, then those levels probably aren't going to work for you because there's nobody else buying or selling based off of levels that you're seeing. What you want to see is some things that are very visual that other traders are going to jump in and give the market that momentum. But the other thing I want to talk about is multiple imbalances in bars. So I call them multiple imbalance bars, and they're just bars that have like 3 or more imbalances, but they're not necessarily stacked neatly on top of each other to give you a nice, neat stacked imbalance. Think of it this way. Think of it as an imbalance turning point. So this was crude oil yesterday, right? Low of the day, right? Then we rallied 50 cents in 15 minutes, right? A nice quick rally. Well, what's happening down here at the low of the day? Well, you have a bar in here with 3 buying imbalances, right? Boom. That's your trigger telling you, hey, you know what? Aggressive buyers are stepping in. Even the next bar had, about 5 buying imbalances in it, right? So you know that there's that momentum now, buying momentum in the market because you have the aggressive trading coming in. So that's your clue. Again, you're not trying to predict the bottom, but once you see the aggressive buying come in, you think, hey, you know what? Maybe this bottom can hold, and I could buy, because where's your stop going to be? It's going to be at the, just below the low, because if you take out that low, then this aggressive buying doesn't, the whole premise for getting long off this aggressive buying is no longer there. But when you buy, then you start seeing more aggressive buying coming in. That's what you want to see. You don't want to see aggressive selling coming in if you're trying to buy. This was gold yesterday. This was gold Monday, right? Got $5 rally after the low has been established. Well, what can you see in this low that's going to give you a clue? Well, you got a bar with 1, 2, 3, 4, 5, 6, 7 buying imbalances in it. All right, that's your clue that, you know what, the aggressive buyers have finally stepped into the market. Maybe this market could finally start moving higher, right? Then you just sort of see in the next few bars sort of go sideways. But more importantly, you don't have that aggressive selling moving the market down. You're still seeing some signs of aggressive buying before it finally pops up and makes a nice $5 move. This is Japanese yen. Okay, you're at the high of the day, 88.87, and then the market sells off all the way down to almost 88.00. But what's happening up in here? Right, this is where looking at the order flow is just going to give you that extra advantage over other people. You'll notice it hits this high, it comes back towards it, can't get up there before it finally starts grinding its way a little bit lower, then boom, the bottom just falls out. But it's clear as day here on a footprint chart. If you're looking at the order flow, you got multiple imbalances in here. 1, 2, 3, 4. Right, you'll notice what the software does is it puts a box around the bar. Right? It's not brain surgery. I like to call it, oh, this is the order flow imbalance algo. No, it's not. It's simple. There's people out there that will, try and sell you a bag of beans, but it's really just simple, right? It's simple tools to make trading easier, right? You got the box around there telling you that you have aggressive selling coming into the bar, right? Now, you're at the high of the day. You always want to be asking yourself, is this market going to keep going higher, or is it going to react off this and sell off? Well, when you start seeing the aggressive selling coming in, you should, put that thought that the market's going to go higher sort of on the back burner, because you have aggressive selling at the high of the day. Just as in the gold earlier, aggressive buying coming in at the low of the day, right? Crude oil, aggressive buying coming in at the low of the day. Going into the lows, you're expecting to see aggressive selling, and you see these bars, multiple imbalances, multiple imbalances, multiple imbalances. Even this bar, multiple imbalances, right? That's what you see, these magenta boxes around. But finally, you see the green candle, the up candle, with the purple box on you. The aggressive buying is coming in, but it's spread out in the bar, right? It's not neatly stacked, 3 in a row on top of each other. This gold one, it's spread out as well. You get 7 imbalances, but they're really spread out in the bar. So again, if the market's moving quickly, it's not something you're going to necessarily notice that, there's a lot of buying imbalances in here. That's why we just simply put the box around there to sort of help your trading become easier. Now, the thing that I want to talk about here now is something that it deals with delta in the bar, right? Delta is the difference between aggressive buying and aggressive selling in a bar. And this is a way to see trap traders, right? By using the delta. Everyone talks about trap trader. Oh, there's trap traders in the market. They'll look at a normal bar chart And they'll say, oh, there's trap traders here. Well, how can you tell? Right? They'll say, well, price is rejected because I got a wick here or something like that. It's just all hypotheses, right? They're just guessing. And oftentimes they're guessing it well after the fact that it happened. So when you're looking at delta and trying to determine if there's trap traders, now this is a bit more advanced, but you don't need any fancy tools to see it, just an order flow footprint chart. And I'll show you how to see it in here. Now, this is a 5-minute chart. And you can see this red bar here, right? Normally, when you're seeing down candles, red candles, right, down bars, you expect to see negative delta, right? Like see red candle here, negative delta, minus 3,000. Another red candle, minus 2,000. But this one's got positive delta, 154. There's another one here, positive delta, 765. There's this other one here also, the one in the middle I didn't mark. It's got positive delta of 125. But the important ones are these two, right? Because market sold off, came back up. Market sold off, came back up, starts coming back down a little bit. But you have positive delta. You're like, well, how can the market go down on positive delta? Well, the reason it's going down on positive delta is because you have supply in the market, in this case, in this red candle. So people were buying it, expecting this market to go higher. So someone was absorbing that buying. So those buyers, those aggressive buyers, are getting trapped in the market, right? They're, I don't want to say, someone is trying to trap them, but rather, they're sort of doing it to themselves. They're buying it in hopes the market is going up because there's somebody there absorbing all their buying. That's what's causing the positive delta. Now you can see here I have the ask volume and the bid volume, these top two numbers. So it's 12,586 was the volume on the aggressive buyers, whereas the aggressive sellers was 12,432. That's why you only end up with 154. Similar thing in this other bar. So the market sold off. This was a quick sell-off of about, over 15 points. This is a 5-minute E-mini chart. Came back up, starts selling off, and as you're coming back down, there's people offering it in here. There's supply. You could look at the footprint. You can see, well, 1,200 traded here. That's one of the reasons why you got such a big positive delta. But when it hit this level, 45.90, there's a big seller there. Right? Someone's got supply. So everyone that was buying it, because you can remember, the market just rallied about 15 points. People are thinking, hey, it's going to go higher, right? Market just went all the way up to, 96, 97. It's coming back down 6 points lower. Hey, I could buy it because I think this market's going back up. But there's someone in there offering it out. They're buying it. They can't sustain that move. Market drops, right? Market drops, comes sort of back up towards that level over the next 3 bars before falling over. But that is a sign when you see these red candles with the positive delta or a green candle with negative delta, which I'll show you in a minute. Right? Those are often signs of supply coming into the market, right? Or absorption, in other words, coming into the market. This is what it looked like on the candlestick chart yesterday, right? You can't tell that there was, people getting trapped up in here. They're sort of doing it again. They're doing it to themselves, thinking the market's going to finally start to rally. But there's, bigger traders there that have a lot of supply, happy to sell it to them all day long. And we know what happened with the market yesterday going into the close. Now here's another example. This is Monday, 30th, or Tuesday rather. Excuse me. You rally all the way up to a swing high. Positive delta, 447. Okay, you got positive delta. Why is the market selling off? Well, it's because early in this bar, people are excited, thinking this market is going higher. But it can't sustain that move. Right? So there was people up here happy to sell it to these willing buyers. People here, take my money. Think this market's going up. Once that rush of buying ended, what happened? When there's no more buyers, the market's just going to fall naturally. This is what it did, right? It was a nice move, 4,600 all the way down to 45.90. Quick 10-point move. So 1-minute chart over 1, 2, 3, 4, 5, 6 minutes. Another example, this is crude oil yesterday, right? Again, swing high, big positive delta, 123. Why? It's because market rallied up. People are thinking, hey, this rally's, I got to get in. FOMO. Get me in. Okay, they got in. Well, unfortunately, that was the end of the move. The sign is right here. The red candle, the down candle with the positive delta at the swing high. Market dropped literally in the next 3 minutes, 4 minutes, almost 75 cents. Right? Quickly, right? It's not something you're sitting there trying to, wait all day for. These are, when you're dealing with order flow, the moves can happen very quickly. All right, it's not something that's just going to sort of meander. Now, earlier you had a bar here. There's a red candle, kind of at a swing high. It sold off a little bit, not the dramatic sell-off that you have here. But then it just sort of went sideways before coming back up. People say, well, yeah, you had this one trade here and it was maybe a loser, right? I mean, I don't know. Maybe you could have scalped a few ticks out of it. Noticing that was coming back up, maybe you scratched it. But really what you're looking for with the order flow is the move to happen fast. If it doesn't happen within the next couple of bars, chances are it's not going to really happen. But again, are you willing to take this trade here? This is a trade I would take. Okay, it didn't work out. You scratch the trade, maybe you lose 5 cents. You take the next one. Boom, it's never really against you. Once you get in, once this market starts dropping here, you get in. It doesn't come all the way back up here. It doesn't test the high. It just immediately moves the way it's supposed to move. This was, again, crude oil. Now, this was on the low yesterday. Okay, what do you see here? Well, you see negative delta. It's an up candle. It's a green candle. So what's that telling you? You had supportive buying in that market. You can see it in here, 78, 70, 70. You're seeing some strong bids in here. So aggressive sellers are selling into these bids. These bidders were happy to absorb all their selling. But once these guys are done selling, there's nobody left to sell. What do you think is going to happen? Well, market's going to rally back up, right? This time it rallied another 75 cents, in about 15 minutes. Now, a lot of the examples I show you is at the highs or the lows, swing highs or swing lows, or highs of the day, lows of the day. But you have to understand it can happen anywhere. Now, I don't like to just take it because it happened, right? You got a red bar with positive delta or a green bar with negative delta. I like to put it in context, right? So if I can see, sort of a market is sort of topping out and start coming down, I'll take it. Not necessarily in the middle of a move, but that's why I like to see them at highs or lows, swing highs or swing lows. This was like an hour ago. This was in the S&Ps, right? Market shot up and then sold off, right? What do you have up here at this swing high? Clear swing high. Positive delta, right? There was aggressive buying in here, but there was also met with supply, right? There are traders there happy to absorb all their buying. And then the market did what it's going to do once that aggressive buying finishes. Then you'll notice right after that, what do you see? Bars with multiple imbalances. You're seeing stacked selling imbalances. So not only do you have traders that are trapped up here, but then as the market starts moving, there's lighter fluid is thrown onto the fire in the terms of imbalances, stacked imbalances, multiple imbalances, telling you that, hey, sellers are coming into the market and they're coming in strong. So even if you're like, well, I'm not sure about this high, once you start seeing the aggressive selling coming in this bar, and you're getting in here, at 46, just a quick 10 points in 5 minutes this morning, so hopefully you can see things and how to use it. Now you can see, what the importance is of delta, what the importance is of imbalances. I haven't even touched on point of controls. I mean, that's a whole another training session. But if you're interested in that, go to my YouTube channel. I got a lot of information on how to understand what's happening in the order flow with point of control as well. So remember, right, the information you see on your bar charts come from what's traded in the market, right? What you see in the time and sales. But a candlestick chart, your bar chart, leaves out the most important part of data, the volume traded on the bid, the volume that's traded on the offer, and more importantly, how to use it, right? Because it's one thing to have that information, you got to know how to use it, and you got to format it as well, right? And that's what the footprint chart does, is it helps you format the data so that you can use it and analyze it. So always trade in context of the market. That's what being a trader is all about, right? You don't just go out and start trading every bar that a multiple imbalance appears. Put it in context of the market. Don't go out and trade every bar that has a diverging delta. Put it in context of the market. That to me, that's sort of the holy grail of trading, is putting the information that you're seeing in context, right? It's not that every time you see an instance of something happening in the market that you just got to go and take that trade. No, you got to put the puzzle piece in the puzzle, right? That's how you're going to solve it. So in the past 40 minutes, I hope you're going to agree it's been time well spent. But again, I can't cover everything in a 60-minute training session or even a 40-minute training session. But I got a special offer that you get everything you need to know about order flow. And if you act fast, I'll give you a very special deal. And earlier I talked about the Orderflows Trader 3.0. And again, you saw the charts that I used in this presentation are generated from the Orderflows Trader 3.0. And it works on NinjaTrader 8. It's not available for other platforms. It's NinjaTrader 8 right now. And it's the volume footprint chart with 17 pre-programmed order flow tools. I talked about the multiple imbalances tool today. That's just one of them, right? And I like software that's easy to use. I don't like to buy software and have to spend an afternoon trying to figure it out. It really is. It takes about 2 minutes to set the whole thing up. You don't need templates or anything like that, because the default settings are defaulted for an E-mini 1-minute chart, which is where most traders start. And its normal price is $899. And you're not going to pay that today. But really, what the Orderflows Trader is like, it's like taking a HDMI cable, plugging it into my brain, right? So you can see what the institutional traders are doing in the market, right? Because you want to know, these areas of importance in the market. Now, having order flow software is one thing. You still got to know how to use it, right? So I provide a lot of further education on how to trade with order flow. So, again, if you take my special deal today, you can get access to my order flow trading course, which I normally sell for $297. You can get that for free, but I'm going to also throw in access to my Inner Circle video series, which is 56 advanced order flow videos talking about little tips, analysis, and tricks. So if you add the software, the training, and the video series, that's already almost $1,700. Now, I realize it's one thing to learn from videos and books, but it takes discipline and commitment, to sit down and watch this. Right? I've got a lot of courses I've bought that haven't been watched. So what I found very helpful is to provide live training where you can come in and ask questions. So for the last 2 or 3 years, I've been doing a live user session every Tuesday night where I drive home what I see in the order flow for the past week. You can ask your questions and areas that you're going to be struggling in your analysis. Now it's free for all users. There's over 146 videos in there, so it gives you an idea of how long I've been doing this for. It's every week, so I'm at week 146. Some companies want to charge you extra for that training. We give it to you for free. So, you're already pushing about $1,800, $1,900 for all this, but you're going to get it for just a one-time payment of $749. You just got to go to orderflows.com/oft3. And you just click on the link in there, put it in the chat there for people. There's no monthly recurring payments or any other payments in the future. Of course, you do need a real-time data feed. But again, what other people are saying about the software is, it's been remarkably helpful. I can clearly see now what's happening in the market, right? And really, that's what you want to do, is you want to understand what you're seeing in the market. So you just go to orderflows.com/oft3, OFT, the number 3.html. Page looks like this. Scroll down, get to the page, click here to buy now. Now again, I got some other instructional videos and examples that you can take a look at. And you're going to see it's just a one-time payment of $7.49. Takes you to PayPal. It's processed through PayPal, which everyone has. I don't want your credit card information. I don't need it. It's just a one-time payment. And as a special bonus for people that came in through Investors Expo, I'm going to give you access to the Orderflow playbook, which is one of my favorite courses that I've made. It's got a bunch of trade setups in there that you can also look for in the Orderflow. Normally it's $297. You're going to get it for free. So get started, right? Just go to orderflows.com/oft3. This is what you're going to get: the Orderflows Trader software, the trading course, the Inner Circle video series, access to the weekly group training, and the playbook. But again, it's just a one-time payment, $7.49. To get my book, just go to orderflows.com/book.html, enter your name, email address, and it takes you to the next page to where you can download it. So get started, right? Just go to orderflows.com/oft3.html. All right, Anna. I don't have time for questions, but I put the links in the chat. If anybody's got any questions, just shoot me an email. It's mike@orderflows.com. So I'll throw it back to you, Anna. Thanks for having me. You're welcome.